How do subsidiaries generate revenue for a holding company?
Hello everyone. Today we are going to demystify how subsidiaries generate revenue for holding companies. This topic can seem a bit complex at first, but it's essential to understand how large corporations operate. Let's dive in to unravel the process step by step. Remember, understanding these dynamics is key to comprehending the world of business and finance.
What is a holding company?
A holding company is a business entity, usually a corporation or limited liability company, LLC, that owns the outstanding stock of other companies. The term holding, in this context, means that the company's primary purpose is to hold and manage investments. The holding company doesn't produce goods or services itself. Instead, its purpose is to own shares of other companies to form a corporate group.
What is a subsidiary?
A subsidiary is a company that is wholly owned or controlled by another company, which is known as the parent, or holding, company. The subsidiary can be a company, corporation, or limited liability company. In some cases, it is a government or state-owned enterprise. The subsidiary operates independently of its parent company while benefiting from the resources, branding, and strategic direction provided by the holding company.
How do subsidiaries generate revenue for holding companies?
Subsidiaries generate revenue for the holding companies primarily through dividend payments and value appreciation. Let's understand these in detail. 1. Dividends. When subsidiaries earn profits, they often distribute a portion of these profits back to their parent company in the form of dividends. The size of the dividend payment will depend on the subsidiary's profit levels and the dividend policy set by its board of directors. 2. Value appreciation. If the subsidiary increases in value, perhaps due to successful operations, strategic moves, or favorable market conditions, the holding company benefits because its ownership stake is now worth more. This increase in value can be realized if the holding company decides to sell its stake in the subsidiary.
How do holding companies benefit from their subsidiaries?
Holding companies can see significant benefits from their subsidiaries. These include 1. Diversification. By owning multiple subsidiaries in various industries, holding companies can spread their risk across these different industries. This diversification can lead to more stable profits and less vulnerability to industry-specific risks. 2. Control. Holding companies have significant control over their subsidiaries, allowing them to make strategic decisions that can improve the profitability and efficiency of the entire group of companies. 3. Tax benefits. In some jurisdictions, the flow of dividends from the subsidiary to the parent may be tax-free or taxed at a reduced rate, providing significant tax advantages. 4. Income stream. Subsidiaries can provide a steady income stream to the parent company through regular dividend payments. In conclusion, subsidiaries are a vital part of a holding company's operations, providing significant revenue, strategic benefits, and diversification. They form an integral part of the global business landscape, and understanding their operations is key to understanding the corporate world. Remember, even though these might seem complex, they are fundamental aspects of how businesses grow and diversify. I hope this video has been helpful in explaining how subsidiaries generate revenue for holding companies. Stay curious and keep learning.